Welcome, ladies and gentlemen, from me, Guy Munson, to our regular 6-minute strategy summary. Despite the extraordinary challenges of the world economy today, both geopolitical and economic, financial markets are starting to perform a little better. For the quarter to date, US equities are up 7%, European equities up 8%, bond yields are down, and even the mighty dollar has fallen modestly since the start of the month. This could of course be just another bear market rally as we saw back in August, or it could be the beginning of something slightly more substantial. We're getting more optimistic. First, there's a rising conviction that the US economy is slowing and that rates of around 4.75% to 5% will mark the peak. This is good for bonds. Second, the corporate supply chain is easing. Transportation costs are coming down, raw material costs are falling, industrial commodity prices are falling. This is good for corporate earnings. Thirdly, investor sentiment is almost fanatically negative, and this is always a good contrarian indicator. Finally, much of the damage from Truss's diabolical mini-budget has been reversed by Hunt's policy U-turn and Sunak's new administration. This has been recognised globally and is giving a boost to confidence. In the slides ahead, we'll consider whether in their totality these changes are enough for investors to increase their risk content in the weeks and months ahead. Let's begin with asset market performance for the year to date, and you can see there declines in almost every asset class as US interest rates in green have steadily been ratcheted up. But to the right of that dotted line, which marks the beginning of Q4, you can see the beginnings of a rally in blue world equities, in yellow gilts, and in green the Nasdaq. On the right-hand panel, I've shown US Treasury yields and the US dollar index in red. Although that mighty dollar has continued to rise, putting so much pressure on global markets, you can see that for the last few weeks it started to roll over, touching now 110 on a trade-weighted basis. So are these the first signs of spring? Is this the beginnings of a longer-term upturn, or is it just another bear market rally like we saw in August? We're a little bit more optimistic. Why? For the first reason, we think there's a rising conviction that US interest rates are going to peak somewhere around 4.75% to 5%, and this will be good for bond markets. Why do I feel this? Well, certainly the trajectory from the US Federal Reserve shows a peak at around that rate in mid-23 and then falling quite consistently forward from there. This is a poll of FOMC forecasters. On the right-hand side, at the same time, we've seen a sharp backup in US mortgage yields, almost doubling for the year to date, the 30-year mortgage now 7.3%. That, of course, puts considerable pressure on housing, so on consumer demand, and will add, I think, to a pull-down on US inflation expectations in the months and years ahead. The second reason why I'm a little bit more optimistic is the corporate supply chain has sharply improved. On the left-hand panel, you can see the collapse in container costs from Shanghai to Los Angeles in that blue line. Not quite back to the pre-COVID years, but a substantial drop. The global supply chain pressure index, which measures delivery times and product costs coming into a factory, again declining sharply. Industrial commodities falling, particularly on weak Chinese demand. Crude oil relatively weak despite those supply cuts, and really encouraging at last some weakness in natural gas prices in Europe. I've shown the UK there, and you can see that decline over the last few weeks and months. The third reason I'm modestly optimistic is that valuations look a lot more sensible than they did 18 months ago. I've shown there the 1-year forward PE multiple of the World Equity Index in blue. That's at about 14.5 times. Not super cheap, but markedly below the 20-year average. We're also getting quite attractive dividend yields. European forward dividend yields are 4%, UK 4.6%, and in the US, if you include very strong buybacks for a sort of measure of total shareholder return, dividend and buybacks are topping 4.8%. So yield support in markets. Fourthly, fund manager sentiment itself is extremely bearish, and this is a good contrarian indicator. In other words, a lot of the selling has already been done, so a spark of good news triggers a robust rally. On the left-hand side, you can see the result of the Bank of America Fund Manager Survey, where they asked fund managers, at this time, how would you rate the potential risks to financial market stability? Well, with high geopolitical risks and high monetary risks, they actually rated risks overall higher than they were in 2008 or in the COVID crisis of 2020. Now, we have many challenges today, but I don't think those risks are really higher than those previous examples. On the right-hand side, I've shown the bull-bear spread, a very long survey of US private investors. At minus 33.6, it's almost maximum bearish. So a good contrarian indicator. Finally, I think the pivot away from Truss's diabolical budget has not only helped the backdrop here in the UK, but helped it globally. Just to see the extent of the reversal on the left-hand side, I've shown British debt to GDP ratios at about 90% at the beginning of this year. And then that dotted white line was the trajectory that Sunak had us on when he was Chancellor. Then we get the Truss budget and it explodes to the upside. That's that yellow line, taking us up to almost 120% of GDP projections on Bloomberg's numbers by 2039. The blue line is Hunt's reversal and U-turn of many of the strategies, and the pink line is where they've got to get it to today. So this extremely dramatic fiscal pivot has restored confidence not only in the UK but globally. To the right of that dotted line you can see corporate bond yields have fallen back to 605, gilts have rallied to 363, mortgage rates hasn't yet moved but they probably will. So what does this mean in totality? Well, it could be that the worst is over. We're still nervous, cautious, but we're taking our first steps to add in a little extra risk. We've done this so far in corporate bond markets by adding corporate bond exposure, and in the currency markets by rebuilding our sterling weightings and sterling hedges on the back of what we think is much more convincing policy. We haven't taken the step yet in equities, but we're reviewing allocations in our meetings over the next few days. So one swallow doesn't make spring, but perhaps some slightly encouraging numbers going forward that means a higher risk appetite in the months and years ahead. Thank you very much.